Welcome to the Master the Margin podcast, your dose of pharmacy accounting and tax topics to help you take your pharmacy to the next level. And good morning, everybody, to another episode of Master the Margin,
Hey.
where we talk about pharmacy accounting and tax topics. And Kathy, this is really, I was thinking about it over the weekend while we were at AmeriSource and you were at Cardinal trade shows where there's really going to be unlimited topics to talk about on this podcast. There's just so many. But piggybacking off of our inaugural episode, Fundamental Accounting, which is going to be the theme throughout this whole series, because without that, a lot of the things we talk about is impossible or not going to happen. So fundamental accounting is something you're going to hear quite a bit every episode probably. But piggybacking off of that, Kathy, we're going to hit on the balance sheet. And the balance sheet is a snapshot in time. There's a formula to the balance sheet. Kathy, what's that formula?
Assets equal liabilities and equity.
Plus equity. And that is the first thing they teach you in accounting class is that formula there. And so the balance sheet really is the fundamental piece to the whole accounting system, to the business. And again, it's that snapshot in time of where you are from an asset perspective, liabilities, and equity perspective. And if we talk about the assets, what are some, Kathy? Let's go through some of these common assets that are that a pharmacy may see on that balance sheet.
So if we start at the top of the balance sheet, you end up with your cash, your savings accounts, any cash on hand. You know, those liquid assets. And then we work our way down to current assets, which is any receivables. And when we talk about receivables in pharmacy, we're talking about your customer store charges, your third-party receivables from your adjudicated prescription claims. And don't forget, if you have med billing in your facility, that's another receivable that we need to be reflecting on your balance sheet. We need to know how much is outstanding on the med billing side. Any employee loans, of course, inventory, which is what's behind the bench, plus anything that you have out front. And don't forget the inventory that you have stashed in the back room, that seasonal stuff that either you haven't brought out or the inventory that you're staging seasonally for Christmas or Thanksgiving or whatever to come. And then, of course, you have your fixed assets, your shelving, your furniture, computer equipment, printers, robots, and less accumulated depreciation because you can't expense those items the minute you buy them. You have to expense them over what the IRS allows as their usable life. And then directly below that, sometimes you have stock or membership equity in your buying group, or goodwill where you've bought your script files from another pharmacy, and those are amortized over 15 years. Did I hit everything?
You hit them all. And another thing to pick up is you mentioned receivables. Another area of receivables that you may miss because you have separate NPI numbers, I believe, or NCPDP. I get those two mixed up. But is the receivables from a combo shop, long-term care. You need to make sure that you're also getting those receivables because they may be tracked separately.
They are tracked separately.
Yes. And so you need to make sure you're tracking those. You mentioned depreciation in those fixed assets, vehicles, robots, improvements. If you have to do USP 800 improvements or something like that, those are all fixed asset items that are, as Kathy mentioned, written off over a period of time. There are tax elections that allow you to write those off quicker than normal depreciation rules at the IRS. And we'll probably get into all that in another episode.
Well, wait a minute. You missed one.
What's that?
We both missed it. The building. If you own the building is a fixed asset.
It is.
You can possibly do a cost segregation study to depreciate that faster than the 39 years that most accountants depreciate it at.
So typically, you don't see a building inside of a pharmacy. And I believe that's going to be a whole nother episode just on that topic, building cost segregation study. But that can be an asset on the fixed assets. And then you have those other assets that you mentioned, Kathy, goodwill, the equity in your buying group, whatever other assets you may have. One other thing I want to mention is that you have all these assets. They have kind of different categories: fixed assets, other assets. You want to make sure that you're tracking those current assets, and the current assets are assets that typically can turn into cash within 12 months. So broker account, let's say you have a broker account where you're putting excess money into some bonds or something. That can be liquidated most likely in a short period of time and turn into cash. So that would be a current asset. Inventory is a current asset. That's going to turn into cash hopefully within 30 days or 15 days. Receivables, current asset. You hopefully collect in 20 days, 21 days. Your cash obviously is a current asset. Having those current assets categorized correctly versus your other assets is important, because as we get down the road here and get into KPIs and different metrics and performance measures, you need to be able to categorize those correctly.
Yep.
And so that would, I guess, Kathy, wrap it up on the asset section at this time. I'm sure we're going to deep dive into each kind of more of these in particular, but just starting with the balance sheet and what we're looking at, you got assets equals liabilities plus equity. Those are your assets you need to be paying attention to. Appreciate everybody listening in, and we will see you on another episode.